Good evening everybody, welcome back to the channel. One of the biggest misconceptions that we hear when it comes to investing is that you need a lot of money to begin, and in reality, nothing could be further from the truth. In today's video, we're going to be breaking down this misconception, and we're going to be looking at an investment strategy which requires basically only $1 a day. We're going to be talking about how to build wealth effortlessly because sometimes the power of small investments can be huge. Let's talk about that, and we'll also be speaking briefly on compound growth, so make sure to watch all the way until the end as it's going to be a really useful video. Let's start off with a brief introduction. Investing does not have to be complicated or expensive. Can just $1 a day make you wealthy? Well, absolutely. We're going to break down the strategy, the numbers, and how you can start this today. Let's get in and start talking about the power of consistent investments. Now here is some basic maths, but it kind of adds up. $1 a day is $30 a month. Over a year, that's about $365. So already, that's not an insignificant amount of money to put away. And again, imagine if we made this $2 or $3 or $4 or even $5, right? We've already got a decent amount of money saved there. And then when we start to talk about compound interest, something that we've spoken about before, small investments can grow exponentially. You see, with compound interest, time is the key, and consistency really can help. Let's talk briefly about how compound interest works. The idea is that your money earns interest. That interest itself earns interest. And over time, this can lead to exponential growth. An example of it is this. If you invested $1 a day at a 10% annual return over 30 years, you would actually amass $66,000. Because that is just the power of the compound growth, right? The interest on the initial investment, then over time, if that money is reinvested or kept in the investment, it will continue to grow and grow. And over time, this growth becomes exponential. Let's talk briefly about where you could possibly invest $1 a day. Now, of course, make sure to do your research. We are not financial advisors here, but here are a few ideas. One is index funds. Index funds like the S&P 500 and ETFs. The idea is that these are low cost, they have a proven history of long-term growth, and generally they've done quite well. Then we can talk about dividend stocks. The idea of these is that you can earn passive income whilst growing your wealth. Then we can talk about robo-advisors. These can be automated and beginner-friendly investing strategies. Then we have high-interest savings for an emergency fund. Now this is also really important. You know, everybody really likes to rush into their investing. They want to make as much money as possible, but the reality of it is you need to be careful. And having some emergency funds is basically an essential thing. So if you can have those emergency funds in a high interest account, it could also massively help you to build your wealth over time. Here's some real life examples of compounding. Warren Buffett, for example, started small and reinvested. If you would have invested $1 a day in the S&P 500 since 1990, you would now have over $200,000. The key takeaway here is that time in this market beats timing this market. You know, this is a big, powerful quote that we speak about a lot. Time in the market beats timing the market. I think that one kind of makes sense, right? Over the years, your interest, your compound, your growth, the market as a whole generally grows better and faster than people who try to time the market. And we see this all the time, right? Hedge funds cannot make often the same return that even the basic S&P 500 return rate is annually. So time in the market is definitely a big important thing. Let's talk about some steps that you can take action on today. Number one could be opening some sort of an investment account. Here are a few examples. Of course, others are available. What you can always do is set up some automatic daily or weekly investments. So what this would mean is, let's say you get paid on the 31st or the 30th. What it would mean is, on that day, maybe $30 comes out of your account and goes straight into your investment account. That way you don't have to think about it. It's easy, it's automatic, and there's basically no thought involved. It's almost impossible to mess up. 3. Choose a low-cost index fund or ETF if that's the way that you want to go. Again, low cost is great. Low cost is almost essential. It's the best way to get the maximum return out of your investment. Then we can talk about reinvesting the dividends and staying consistent. And again, this is where you start to get that exponential growth, right? Reinvest. Some people would take profits on their investment, but the key to make the most of it, the key to get that exponential growth, is to be consistent and continue to reinvest. And another big one, especially for long-term investors, is ignoring market fluctuations in the short term. Try and focus on the long-term growth, and that can be quite difficult sometimes if we actually think about it. When market downturns happen or certain trends in the market that we're basically not comfortable with, it can set us off on the wrong footing, but the reality of it is, over time, over the past 30, 40 years, right? If you look at the trend of the market, it's generally been upwards. And of course, we can't use past data to indicate what happens next, but it's just an example. People who held for the last 40, 50 years would have done pretty well. And a lot of people tried to time the market or got nervous, and they ended up losing quite a substantial amount of money. So it just goes to show, right? Here are a few of the common myths and mistakes to try and avoid. Again, we spoke about this. I need a lot of money to start. This is false. We're speaking right now about how you can start with as little as $1 a day. Then we hear that investing is too risky. Long-term, diversified investing is a lot of the time safer than saving. And the big reason for that, of course, do your research, but our fundamental principle behind this is, if you think about it, saving money in cash with inflation, your money over time goes down substantially. Like over a 20, 30, 40, 50-year period, your money will basically be worth a significant amount less than what it was when you started. Whereas investments generally over long-term periods tend to rise. So you kind of see that here. You see what the real risk is in terms of actual capital management. Then we've got the people who say, I'll wait for the perfect time. The truth is, time in the market beats timing the market. We said it before, we'll say it again. Waiting for the perfect time does not really exist. We have people who generally tend to average in. Maybe they put in 30 a month, 50 a month, 100 a month. That generally over a year, 2 years, 10 years, 50 years will create better results than putting a significant amount in at one time, or even worse, not investing at all in the hopes of waiting for the right moment. So, the long-term wealth mindset. This is another very important thing. Wealth is built through patience and consistency. The earlier you start, the bigger the impact can be. This is, of course, the compound effect. Investing just $1 a day can put you on a path to financial freedom. It may take time, but it can be done. So start today and let time do the work. Here are a few final thoughts, right? Small steps that you can take today can lead to big results tomorrow. Again, with small investments, with compound interest, with saving as much as you can. Even using the $1 a day investing strategy, we've spoken about the results that you can gain. Now imagine if you could do that at $2, $4, $8, $100 or so. So if you enjoyed a video like this, make sure to like and subscribe. Do share it with anybody if it was useful to you. And I hope I will see you again, guys. Thank you and see you soon.